Accounting Boffins. You are with Ashraf Patel and the crew, and today we're looking at the creditors reconciliation. You must be asking, why another creditors reconciliation? Remember, we said earlier on there are two types of creditors recons, and today we are looking at the external creditors reconciliation statement. So therefore, have you thought about this? What is the relationship between a business and its creditors, right? And I'm going to take you back slightly to one of our previous lessons where we dealt with the bank reconciliation. Now, remember, our relationship with us and the bank is that of debtor and creditor. I hope you recall that lesson. Similarly, when we're dealing with a creditor, the relationship is almost identical to that of our bank. However, it's not because our money is with the creditor, but rather we are buying goods on credit from the creditor. So keep in mind the concepts and principles that we applied when we worked with the bank reconciliation statement, and I promise you, if you understand that relationship, then definitely you're going to see the similarities between a bank reconciliation statement and obviously what we're doing today, the creditors reconciliation, the external creditors reconciliation. Okay, why do we need to reconcile? Obviously, the statement that we receive from our creditor, right, almost the same as the bank statement that we are receiving from our bank, compared to the creditor's ledger in our account. So obviously you can see the two have to mirror one another. In other words, they have to be the same. But generally, because of differences, timing differences, errors, omissions, etc., it becomes necessary to draw up a creditor's reconciliation statement where we are reconciling, and this is the important part, what? The statement that we are receiving from our creditor with the creditor's ledger. That's our creditor's ledger with the creditor's individual account. Right, okay, let's move on. Let's look at a few keywords here. Number one, what is the creditor's control account? Remember that your creditor's control account is a summary of your creditor's ledger, right? Therefore, it reflects the total amount owed to all the individual creditors. In other words, the creditor's control account will not tell you the specific amounts that we are owing to individual creditors. Rather, it would give you the total amount that's due to all your creditors. Therefore, you find that the balance of the creditor's control account must correspond with the statement received from the creditors. Now, obviously, what we're referring to here is all the statements that we are receiving from all our creditors. If we add up all those statements, it must agree to the balance that is appearing in my creditor's control account. Just by way of revision, remember, a reminder is always beneficial. We already completed the recon where we reconciled our creditor's control account with our creditor's list. Do you recall that one? Yes, that was what we referred to as the internal creditors reconciliation. And what were we reconciling? The creditor's control account with our creditor's list. It had nothing to do with the statement that we are receiving or that we are dealing with now when talking about the external creditors reconciliation statement. Okay. Then, again, reminder, a creditor's list is a list of people that the business owes money to. In other words, let's just take it back a few steps. Number one, the creditor's control account in our records is a summary of the creditor's list, right? But the focus of today's lesson is not to reconcile the control account with the list, rather to reconcile the creditor's individual account as it appears in our ledger with the statement that we are receiving from a specific creditor. I hope that clarifies it. So now we know what our goal is. Our goal is to reconcile the creditor's statement, a particular creditor's statement, with that creditor's ledger account as it appears in our creditor's ledger. Okay, we got that? Let's move on. Now, what is your creditor's cycle? What happens? Very simple. The process of reconciliation from source documents, which eventually leads to us drawing up the creditor's control account and obviously receiving the creditor's statement. Let me explain. Obviously, the transaction takes place by means of source documentation. The documents are recorded in our books as well as recorded in the books of our creditor, right? We update our creditor's control account in the general ledger, as well as updating the creditor's personal account in the creditor's ledger, right? So we've updated all our records. Once again, starting from the source documentation to the eventual entries in both the general ledger and the creditor's ledger. Remember the triple entry principle? Again, let me remind you, your double entry in your general ledger, for example, if you bought goods on credit, you will debit trading stock and credit creditor's control. That's the entry in your general ledger. But at the same time, you will credit the creditor's personal account in the creditor's ledger. Right. Okay, now, that process is completed by us. All the transactions that we enter into with our creditor is also recorded by the creditor in their records. And that is why what they do then, at the end of the month, the creditor issues a statement to you, which you then compare with the ledger account in your records. Once again, on a continuous basis, I'm going to remind you about drawing a parallel between the creditor's reconciliation statement, the external one, and the bank recon. Let's look at this example. The bank sends you a statement indicating all the transactions that you've entered into with the bank. At the same time, you have entries in your bank account indicating the transactions that you have entered into with the bank. So you can see the similarity. So here we go once again. Creditor sends you a statement. You're looking at the statement. You're reconciling it with the creditor's ledger, that specific creditor's, that individual creditor's account. And you're drawing a comparison and you're checking if the information appears correctly in both the creditor's statement as well as your creditor's ledger account. Okay. Remember, part and parcel of your reconciliation is internal control. Now, what do we mean by internal control? Once again, internal control, the purpose of internal control is to safeguard the assets of a business. Therefore, when we're looking at internal control, we are making sure, we are ensuring that all the items that were received were linked to the correct documents. Did we order these goods? Who ordered it? Did we go through the process of procurement in the correct procedure? Very important. How did we, who decided that these goods must be ordered, right? Control that the goods were received correspond with the invoices at delivery. Yes, this is what we ordered. This is the order form. Does it correctly correspond with my invoice? The invoice, is it checked at delivery? Are we in fact receiving the goods that were ordered? So you can see the purpose of internal control is to safeguard our asset. Which asset in this case? Trading stock. Also, the goods that we are receiving, right? Control that no goods are damaged. Obviously, if the goods are damaged, then those damaged goods need to be returned to our suppliers. And also, if we're continuously receiving damaged goods, then obviously we need to look at an alternate supplier. Remember, accounting boffins, all of this forms part and parcel of internal control to ensure that when we are ordering goods from our creditors, are we following the normal channels? Are we following the procedures? Remember, we have certain people that are in charge of ordering the goods. There should be different people that are receiving those goods. Obviously, the reason for that is division of duties to ensure the protection of our asset, namely trading stock. The goods that are being received, are they the actual goods that we've ordered? And like we said earlier, if these goods are damaged, then these must be returned to the supplier with a debit note. And also, if it is happening frequently that we are receiving damaged goods or goods not to specifications, then what do we have to do? Obviously, then the business has to relook its policy and also find an alternate supplier, because surely we can't be doing business with a supplier that's sending us damaged goods or goods not as per our order. So if we conclude this process of internal control, once again, we have to ensure that the goods that we are ordering are in fact the goods that are delivered, and they are in a condition where we are able to sell these goods. Right, guys? We've just touched the surface of the creditors recon. I'm sure you want to know more. So if you want to know more about the creditors recon, stay with Ashraf and the crew. We'll see you just now. Welcome back, Accounting Boffins. You are with Ashraf Patel. Remember, the focus of the lesson is the external creditors recon, where we are reconciling the creditor's statement and the creditor's account as it appears in our ledger. Okay, so here we go. Here's our question. It's on the creditors recon, right? And we are dealing with the creditors recon. What are we saying? We're saying Nabila Traders buys goods on credit from happy suppliers, right? So clearly you can see the relationship between Nabila Traders and happy suppliers. Okay, and what are we expected to do? We must use the table provided to indicate the changes to the creditors ledger account in the books of Nabila Traders, right? And also the creditors reconciliation statement on the 31st of July 2020. So understand this here. What are we doing? We are reconciling the account, and you will see here that here's the information that we have. Here's the creditors ledger of Nabila Traders, and the creditor that we are dealing with is happy suppliers. So clearly you can see, identify who we're dealing with. We are Nabila Traders. Well, who are we dealing with? We are buying goods on credit from happy suppliers. So here's the information in my creditors ledger, right? And what am I comparing it to? I'm comparing it to the statement of account from happy suppliers. Clearly you can see, happy suppliers is the creditor. The business owes money to happy suppliers. Who is the business? We are Nabila Traders. It means we have an account in our records for happy suppliers. Got that? Brilliant. Okay, so clearly you can see now that if we look at the account in our books, it's showing that there's a balance of 147,820. Okay, so according to our records, we are owing happy suppliers an amount of 147,820. When we compare that to the statement that we are receiving from them, we can clearly see, according to them, there's a balance there of 145,060. So obviously, we now need to reconcile. Reconcile what? The statement we are receiving from Happy Suppliers with the account as it appears in our records. Okay. Starting with the first one, it says here, the incorrect entry for debit note number 674, incorrect entry in the creditors ledger account of Happy Suppliers relates to the correct credit note number 741 on the statement. The first thing that you must do, and I've told you this on numerous occasions, in accounting, you need to talk to yourself. Yes, sometimes you need good advice. And who better to give you advice than yourself? So, talk to yourself and ask yourself, where is the error? Step number one, identify where is the error. Let's look at the transaction once again. The incorrect entry for the debit note in the creditors ledger account here. So clearly you can see the creditors ledger account is incorrect. We have made the mistake. And therefore, you can see here now that when we are dealing with this one of 8640, the debit note that they referred to in the question, and we're comparing it to here's it here, credit note number 7416840. So clearly you can see, they're telling you that the statement is correct, right? And we have made the mistake, therefore, how are we going to correct it? The first thing that you're going to do is to find the difference, right? And remember what the amount was. Amount on the previous one was what? Let's get it here. Was 8640. 8640 minus, and the next amount was 6840. So we go 6840, and your answer is a difference of 1,800. Okay, let's do this here, and let's see how we're going to correct it. So obviously, we had deducted 1,800 Rand too much, and therefore, we need to correct it. How are we going to correct it? By doing the following. Watch. The error needs to be corrected in our ledger. So immediately we go to the creditors ledger, right? Immediately we go to the creditors ledger. There's our creditors ledger. What do we have to do? We have to add back the 1,800. There we go. There's the correction. Remember, error made by us is corrected in our books. Therefore, in the creditors ledger, we say plus 1,800. And what have we done now? We've now made the two amounts the same. Remember, that's the idea of a reconciliation, to bring together. Right? Okay, next one. Okay, the next one says, invoice number 282 was incorrectly reflected in the account of Happy Suppliers in the creditors ledger. The goods were purchased from Oasis Suppliers. Once again, the question that you ask yourself, where is the error? Who has made the error? Is the error on the statement, or is the error on our ledger account? Once again, we can see invoice number 282, right, was incorrectly reflected in the account of Happy Suppliers in the creditors ledger. There's the operative word. That gives you an indication of where the error is. So obviously, we now need to identify it. There's invoice number 282 for 40,950. What have we done? We've included it in the account of Happy Suppliers. But certainly, it doesn't belong there because the goods were bought from somebody else. So therefore, if we now correct this here, what do we have to do? Watch. We have included goods that we bought from Oasis, but we put it under Happy suppliers, meaning it is incorrect in their account. So therefore, the fact is we have made the error, so immediately we go to the creditors ledger, right? That's the error. In the creditors ledger, we have an invoice there that doesn't belong there. It belongs to somebody else, another creditor, namely Oasis. So therefore, in the account of Happy, we're going to deduct minus 40,950, and in this way now we've pulled it out. So obviously we are bringing together, we are reconciling. Remember, the idea is to reconcile these two amounts. According to our books, we owe Happy suppliers 147,820, but according to Happy suppliers, we are only owing them 145,060. Clear? Right. Done and dusted. Next one. Invoice number 360 was incorrectly recorded on the statement from Happy suppliers. Aha. Note the difference. First question, that's right. Who made the error? Invoice number 360 was incorrectly recorded on the statement from Happy suppliers. So immediately we go there and we find, let's look at our records. Invoice number 360 is 50,250, which is the correct amount according to our records, because they're telling you it was incorrectly recorded where? Invoice number 360, 20,250. So immediately you can see there's a discrepancy, right? What's the discrepancy? According to our records, we owe them 50,250. According to what they have entered, they entered it as 20,250. So obviously you compare the two, you check which one is correct. This is the incorrect one. Our entry in our records is the correct one, and obviously we then go and correct this here by doing what? Remember, they had 30,000 too little in the statement. Let's check. Here goes. They only entered 20,250, whereas the correct amount was 50,250. Okay, just on this point here, just by way of reminder, remember, when we buy goods from our creditor, we credit the creditor, as you can clearly see, we've done here, because we are owing money to the creditor. But remember, what will they do? In their records, they will debit our account. Why? Because we owe them the money. That is why I said the relationship between a debtor and a creditor. Once again, think bank reconciliation. When we credited our books, the bank debited. When we debited our books, the bank credited our records. By the same way, we're looking at our debtor and a creditor with the same relationship. Okay, coming back to the question that we are dealing with. So obviously, they had 30,000 rand too little in their records. So what do we say? We say plus 30,000 where? And this is what is important. Who made the error? Where was the error? The error was on my statement. Therefore, it will be corrected on my statement of account. Clearly you can see I'm going to increase it by 30,000 rand. Okay, next one. Happy suppliers also purchased goods on credit from Nabila Traders. Nabila Traders has transferred a debit balance from the debtors ledger, voucher number 570. Happy suppliers will offset this on the next statement. So we have a relationship where Happy suppliers are we buying goods on credit from them, right? That we know. But they're telling us that Happy suppliers also buys goods from us. So we have a dual relationship with them. On the one hand, they are our creditors because we owe them money, but they are also our debtors because we're selling goods to them on credit as well, right? So obviously, there was a transfer, and if we look at it, journal number 570, we can clearly see it. There was an amount of 5,400 that we debited in our books. They have not entered it as yet. They will offset it next month. So here we go. You can see it does not appear in their records Therefore, remember, a credit in our books, remember this one here, let's just check it out quickly so we know what we're dealing with. It's a debit in our books here. You can see that 5,400 Rand. So obviously, in their records, it will be a credit as if we had paid them. Okay, therefore, this means that if we're looking at this entry here, how are we going to correct it? We're going to say minus 5,400 Rand. Where? On the statement. Okay, next one. The transaction on the 24th of July is for merchandise returned to happy suppliers. We return goods to happy suppliers. Let's look at the transaction on the 24th, right? There's a debit note, 8,100. Remember, we return goods to our suppliers. And when we're returning goods to our suppliers, remember, we have to decrease the amount that we owe them. Therefore, what have we done? Can you see here? The 8,100 is in the credit column, meaning, therefore, that if we look at their records, you can see here, whereas the credit in their account is correct, we have made the mistake, and therefore, we treated it as if we had bought goods from them, but in fact, we had returned goods to them. Therefore, the minus 16,200 there, that you see there, is a double of the 8,100. And what do? We subtract the amount in our records because of the error. Right. And then finally, we are told the statement reflects transactions up to the 25th of July 2020. So clearly you can see here that this payment here of 77,190 is not reflected in their records. Why? Because we've already received the statement, and you can clearly see we now have to do what? Subtract the 77,190 from their amount, because it's not reflected on the statement. We now have to reflect that amount on the statement by doing what? By subtracting that amount. So what have we done? We have now reconciled the differences between the creditors ledger, the account of happy suppliers, with the statement that we have received from happy suppliers. Okay, guys, we're going to take a quick break, and we'll see you in a jiffy. Welcome back, accounting boffins. Remember, we are busy with the creditors reconciliation statement, and once again, let's just get clarity on what we are doing. We are reconciling what we said was the creditors ledger of Nabila Traders, right? And we are reconciling that with, so once again, the creditors ledger of Nabila Traders. It means we are Nabila Traders, we the business. We are dealing with our creditor. Who's our creditor? Our creditor is happy suppliers. So in our records, we have entered into transactions with happy suppliers, and these are all the transactions that we have entered into with them. Can you see that? At the same time, like we've recorded in our ledger, they have recorded on their statement that we are receiving from happy suppliers, right? Here's happy suppliers, and obviously they are telling you that this is what we are owing them, and these are the transactions that they have recorded. Okay, now, before we continue, let's just check and see, just illustrate one or two concepts from these two, that means the statement and the ledger account, so that we have clarity. Right, at the beginning of the month, according to our records, there's our ledger, we're owing them 67,500, and yes, according to their records, we're also owing 67,500. At the beginning of the month, everything is hunky-dory. The two balances are in agreement, nothing to reconcile. Okay, Then we came across all the errors and omissions and whatever we had to adjust. Remember, we went through each one of them. But before we go to the complete answer, there's something else that I want you to note. I've mentioned it before, and I want to just say it again so that you have clarity. Look at this example here. We have receipt number 695. In our books, let's go to our books first. There's a receipt, there's an EFT payment of 33,750. Can you see it? Where we are saying we are debiting their account, right? And this is important. We are debiting their account. Why are we debiting the account? Because we've paid them. And because we've paid them, we are reducing the amount that we are owing them. So, in our records, there's the debit entry of 33,750. If you go into their records, can you see what are they saying? They're saying they issued a receipt number 695 in lieu of the payment that, or the EFT payment that we have made, and they are crediting our account with 33,750. Now, this is what you need to understand. When we record something as a payment, we are debiting the creditor to reduce the amount. At the same time, when the creditor records the entry, watch, they are saying they are crediting the amount. Why? Because we're owing them less. So, the rule is, obviously we don't learn accounting by rules. The understanding of it is, when we debit our records, they credit. When we credit our records, they debit. Please keep that in mind. Okay. So when you are doing your comparison as well, you need to check that all the items that we have in our records have debited, they have credited, and all the items in our records that we have credited, that they have in fact debited those particular transactions. All right. So now, if we go on and we look at our final answer now, in terms of, remember we did it in steps. We took each error and omission or a difference, and we dealt with it, and each error was dealt with. So we start off with the 1,800, right? Remember the 1,800, there was an error there. There was an error in our records with the 40,950, right? There was an error on the 30,000 Rand where their invoice was undercast, okay? There was an error of the 5,400, which was not in fact the error, that was the transfer from the one account where Nabila Traders also sold goods to Happy Traders, and there was an amount of 5,400 that we offset, which they were going to do. Once again, guys, what do we remember? Errors made by us, that is Nabila Traders, will be corrected in our creditors ledger. Got that? And then errors made by them on the statement will be corrected in the column which says statement of account. So in other words, we're looking at it, we're doing the comparison. These are our records, okay? Our records, meaning our creditors ledger, and this is the statement that we are receiving from our creditor. Once again, I've alluded to this earlier on in the lesson, but I'm going to draw another parallel for you. Remember, this is if you're using your bank recon, because it's prior knowledge. You've learned the bank recon already. You know the bank recon. So what do we say? This would be the bank account, right? As per our records, and this would obviously be the bank statement in terms of what we are receiving from the bank. By the same token, when you're dealing with a creditor, the creditor, this creditor's ledger would be our records in the creditor's ledger, and this would be the statement that we are receiving from the creditor. Okay, if you have that clear in your minds, then definitely you are on a winning ticket in understanding the external creditors recon. Right, so now we've dealt with all the errors. Remember, the 16,200. Just a bit of explanation on this one here. When we recorded the 8,100, we actually recorded it as goods that were purchased from the creditor. But in actual fact, these were goods that were returned to our supplier. Right. Now the question arises, why is it double the amount? Let me show you, if we use single amounts, why it, in fact, the net effect is double the amount. If you only correct the error, right, and the error was 8,100, and if you say minus 8,100 there, then you are only cancelling the error out. You see that? Because you showed it as it, or at least it was recorded in our books as if we had bought goods, but it in fact was a return of goods. So if you only put in the 8,100, it means you're only cancelling out the original error. But you are not recording the actual return of goods. Therefore, it becomes necessary to double the amount. And yes, you can show it as two separate amounts, minus 8,100, another minus 8,100. The net effect of that is a minus 16,200. So what do we learn from this here? That if the transaction is posted to the incorrect side of the debtor's ledger or creditor's ledger, but in this case, obviously we're working with the creditor's ledger. If it goes to the incorrect side of the creditor's ledger, to correct it, you need to double it on the opposite side. So once again, we had returned goods to our supplier. The correct entry would have been to reduce the amount that we were owing them. Let's have a look at it so we can clearly identify it. Where's the 8,100? This is the statement. Here we go. Here's the 8,100, right? There we go. There's a debit note. Can you see? What have we done? In terms of our records, we credited it, meaning we showed as if we had purchased goods from our creditor, which in fact was incorrect because we had returned goods. So the correct entry should have been a debit of 8,100. Can you see? So therefore, what happens now is that to correct it, we have to double the amount for it to then have the desired effect of reducing the amount that we are owing to our creditor by 8,100, right? And then finally, there was a transaction of the timing difference. Remember the timing difference? Let's go quickly to that one there. They said the statement reflected transactions up to the 25th of July only. Okay, so now if you do your comparison, look at our records. We had entered up into a transaction on the 31st of July where we paid and we received a discount, so there was an EFT payment of 77,190. Once again, it appears in our records. Why? Because we made the payment and we recorded it. But remember, the statement was already received by the 25th of July. So obviously, transactions after the 25th of July would not appear on the statement. I mean, that is obvious, as you can clearly see here. There's it. The last transaction that appears on the statement is actually the 24th of July. So therefore, we now have to update. It means go into the statement, and here you can see here, there we go, in the statement of account, minus 77,190. And when we do that, watch what happens now. So you've seen each difference between the statement and the ledger account, which we did individually. Now you're seeing the full picture of all the transactions that we have corrected, right? So you start off with the 147,820, you add 1,800 minus 4,950 minus 16,200, and what does it give you as a final balance? 92,470, right? Then you took your statement and you started with 145,060 plus the 30,000 minus the 54 minus 77,190, and voila. What have we done? We have reconciled the ledger account of happy suppliers in our ledger account, right? We have reconciled their account with the statement that we received from them, and clearly you can see now everything is in order because we have reconciled the statement with the ledger account. So that is what we talk about when we talk about the external creditors recon, where we are reconciling the statement that we are receiving from our creditor with what? With the actual account as it appears in our records. Okay. The question says, the internal auditor insists that direct payments, EFTs, must be used to pay suppliers. Explain. One internal control procedure to ensure control over this, and one reason to support his decision. Now, just by way of explanation, I think what's important to note, with changes in legislation, checks are becoming obsolete and outdated, right? In fact, you're going to find many banks will not allow for check payments or checks to be used in the economy. Therefore, it's going to become imperative for all payments to be made by EFT, electronic funds transfer. Right, okay. So the question says, the internal auditor has insisted that all EFTs must be used to pay suppliers. We've got to explain one internal procedure to ensure the control over this. That means even although you're making payments by EFT, you still need to have internal control over it, right? And secondly, one reason to support the decision. Let's look at it. Firstly, when it comes to your payments, when you're making an EFT, let's just understand what happens here. When you're making an EFT, you're actually transferring money from your bank account into the bank account of your creditor, right? So clearly you can see you're dealing with cash, right? And senior personnel must be authorized to make the internet payments, the EFT payments. So it's just not ordinary anybody that's working in the business that's going to make the payments. It has to be authorized by senior personnel. Number two, you have to use security codes for users. That means depending on which bank you are dealing with, each bank has certain procedures in place where a payment is first made by one person and released by another person. In that way, you have control over the payments that are being made. You have security codes, you have one-time passwords. There's a host of security measures that are in place, and these have to be used in order to ensure, once again, internal control. What's the purpose of internal control? To safeguard the assets of a business. In this case, the asset that we are safeguarding is our bank, our cash that we have in our bank account. Okay. Also, when an EFT payment is made, to get notification from your bank when payments are being effected. So in that way, whenever any payment is made from our bank account, the bank notifies you of a payment being made. And if you are not aware of that payment, then obviously you need to then query that particular payment. Okay. The next one says, why should we use EFTs? Like I said, moving forward in terms of current legislation, check payments are now outdated, are obsolete, so every business will be forced to use EFT payments. What do we know about them? One, they are quick and easy, right? In terms of an EFT payment, all that happens is you go onto the system, you link onto your bank account, you've loaded your creditors on there. By a click of a button, you can actually effect a payment into the account of a creditor. And remember, it's easier to monitor in terms of, think of the challenges. A check is written, a check is lost, presented for payment, etc. In this way, once it is, but the most important thing is that all of these transactions that you make and payments that you make must be authorized, and there must be checks and balances in place to ensure that there is no fraud taking place. Then, if we summarize and we come to conclude our lesson for today, we find one, there has to be proper division of duties. What do we mean by division of duties? We mean, with regards to creditors, somebody involved with the procurement, the ordering of the goods. The receiving must be done by somebody else. The checking to ensure must be done by somebody else. Again, in this way, we are protecting our asset, namely the trading stock. Remember, when it comes to authorizing of payments, please, we must make sure, once again, senior personnel, senior management should do the final payment. That means it could be processed by somebody else and maybe have another person to release the final payment, where the money is then transferred into the account of your creditor. Proper documentation along the entire chain dealing with our creditors. There must be documentation in place, from the order forms, the actual ordering of the goods, the people responsible in that department. Every step of the line, there has to be documentation, there has to be separation of duties. You can also use, sometimes what we also use for internal control purposes is the separation of duties is one, and the division of duties is the same thing, but you can change the rotation of the duties. In this way, people don't become accustomed to their job and don't become too familiar with the transactions that we are entering into. In this way, proper recording, follow-up, purchases, returns, all of it. If we have rotation of duties, people doing different jobs, you're also training your personnel in the event of somebody having to take leave or whatever. Well, guys, that's it for today's lesson. From me, Ashraf Patel, and the crew, we want you to enjoy your accounting, to practice, 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 because practice makes perfect. Until the next time, be good. Bye-bye.